Okay, now let's move on to the next question. What amount should be included in the consolidated statement of financial position for the 5% loan notes as at 31st March 2016? Now here, what we need to do is, now you have 5% loan notes for Park as well as SAM. So when you do the line by line consolidation, you need to add these two numbers. However, you are given in the question, additionally, the Park invested 1.2 million in SAM's 5% loan notes at par value. Now this 12 million, the Park has invested in SAM's company. So Park has invested 1.2 million in SAM's 5% loan notes. This 12 million includes 1.2 million. Okay, so 1.2 million loan notes included here. It's a liability for SAM towards Park. Now the receivable, the amount invested would have been recorded in Park's books as receivables. Okay, so the Park would have recorded as a receivable balance. So since the asset sides, the total is not given, so that amount is already recorded. We'll have to assume that is already recorded under receivables of Park. Now when you do the line by line consolidation, what you need to do is you need to eliminate intercompany transactions. So this 1.2 million is treated as intercompany transaction. So therefore what you need to do is, as you know, all intercompany transactions should be eliminated. These amounts should not be consolidated because the group would end up with a receivable to itself and payable to itself. So therefore receivables and payables would consequently be overstated in the consolidated financial position. Therefore these balances, the intercompany transaction balances, will have to be eliminated. So when you take this total 18 plus 12, so that's going to be how much? That amount is 18 million plus 12 million. It will be 30 million minus 1,200,000. So once you deduct this, it's going to be 28,800. So 30 million minus 1.2 million, 28,800,000. Okay, so this is the correct answer for this particular question. Now the next question, what amount should be included in the consolidated statement of financial position for retained earnings at 31st March 2016. Now the retained earnings of Park, so let's say retained earnings of Park is given. How much is that? Park is given, which is 13 million. Okay, 30 million. You need to add to this 13 million the post acquisition profit of SAM. And what is the percentage acquired? 75%. So 75% of the post acquisition profit of SAM should be added. However, if there are any adjustments to be made to this Park's subsequent post acquisition profit, that has to be adjusted. Now since you are given note number 2, during the post acquisition period SAM sold goods to Park 600,000. So this 600,000, so here it's 600,000, on which it earned a margin of 15%. 70% of the goods remain in Park's inventory at the year end. Okay, so at 31st March 2016, SAM was still owed half of the total amount invoiced to Park for these goods. So therefore, when you go through this particular note, you can see SAM sold goods to Park 600,000 with a profit margin of 15%, of which 70% of the goods remain in Park's inventory. So therefore 70% of the goods have not been sold by Park. Therefore this profit included in this 70% of the goods will have to be removed from the inventory value of Park. So in terms of the group as a whole, so Park and Sam, it's a group of companies, okay? So in terms of the group as a whole, such profits are unrealized. Therefore, it has to be eliminated from the consolidated accounts. So remember, you can't make profits if your right hand sells goods to your left hand. So therefore, whatever the profit margin included in this particular 600,000 will have to be eliminated. Such unrealized profit arise when one group entity sells goods to another group entity and those goods have not yet been sold on externally by the end of the year. So therefore, these are known as unrealized profit held in inventory. So that unrealized profit part has to be removed from the inventory. Okay. So let's calculate that unrealized profit. So let's take the retained profit. Retained profit of P Park is 13 million. To this you need to add the post acquisition profit of Sam after unrealized profit adjustment. Okay. Now let's take the post acquisition profit. As you know, the post acquisition profit is 300,000. This is the post acquisition profit for the remaining. So they are saying during the post acquisition period, Sam sold goods to Park 600,000, on which it earned margin of 15%. 70% of the goods remain in Park's inventory. So therefore, out of this 300,000 for the 3 months period, we need to identify 300,000 divided by 12 times 3, which we calculated 75,000. From this, we need to eliminate unrealized profit. So how do you calculate the unrealized profit? The total sales made by Sam to Park 600,000 with a profit margin of 15%. So which comes to 90,000, the total unrealized profit. So 600,000 times 15, which is 90,000. But however, only 70% of the goods are not sold. It remains in the inventory. So therefore, 70% on 90,000, which will be 63,000, which is not sold. So therefore, this is the total unrealized profit. Now, who recognize this profit? This is what very important. Now, when you take Park and Sam, Park acquired 75% of S and the remaining is non-controlling interest 25%. Now S sold goods to Park. How much is the value of the sale? 600,000. 600,000. Okay, 600,000 with a profit margin of 15%. Okay, the profit margin was 15%. Now, when S sells goods to P, what will be the double entry in S's book? They would have debited, since let's say it's a credit sales, accounts receivable account debit 600,000, sales account would have been credited 600,000. In P's book, this would have been recorded as purchases 600,000 and accounts payable credit, this is debit entry, this is credit entry 600,000. So now what we need to do, we need to eliminate the unrealized profit of 63,000 because of this sale, the sale was made by S, so therefore the profit is recognized by S. In SS books, the profit is recognized. So therefore, the SS profit has to be shared between the parent and non-controlling interest. The parent, which is 75%, and NCI 25%. So therefore, since the profit is recognized by S, this unrealized profit has to be calculated on this ratio, 75% Park, 25% NCI. So since we are going to calculate the consolidated retained earnings, only the park's unrealized profit, which is 75% of this is unrealized profit. So what you can do is from this 75,000, which is the profit earned during this 3 months period, we need to eliminate 75,000. This includes the unrealized profit of 63,000, which is how much? 12,000. This 12,000 has to be shared 75% to a parent park, 25% to non-controlling interest. So therefore, when you take 75% of 12,000, which is going to be 9,000. 9,000 is unrealized. After the unrealized profit adjustment, 9,000 is the post-acquisition profit of SAM after unrealized profit adjustment. So we can't take entire 75,000, of which 75% we can't take. What we need to do is from 75,000, you need to eliminate the unrealized profit portion, which is 63,000. And on this 12,000, 75% belongs to the parent company. So therefore, the 9,000, this is in millions. So therefore, when you add 9,000, which is going to be 13 million 9,000. Okay. So this is the correct answer for the final question. So what amount should be included in the consolidated statement of financial position for retained earnings at 31st March 2016? So which is going to be 30 million 9. So this is the answer for the final part.